Hello, everyone. Thank you very much for joining us for the Nasdaq Dorsey Wright podcast for this Wednesday, October 21st. My name is Ian Saunders, and joining us here today is Charlie Coleman. And Charlie, we're coming in, as y'all touched on last week, looking at some dispersion within domestic equity, specifically looking at the sector side. Coming in here to a domestic equity market, at least today, that's showing kind of rather muted movement. So it's been some areas being slightly down, some areas being slightly up. A little bit of upside over the past week or so here on the domestic equity side. But circling back to that conversation of dispersion, we were looking to expand upon that, to really take the step further today, looking at dispersion within international markets. And as we touched on in the daily equity report right at the beginning of the month on October 6th, we had a piece in the report in the feature for that day looking at dispersion between different factors, both on the domestic equity side and then as well as on the international side. Looking at the international one specifically here today, looking at the dispersion between those international factors, really on the developed specifically, we could see that the dispersion between the two has actually been some of the highest readings that we've seen between the top performing factor in international equities being momentum, similar to domestic markets, and the lowest performing on a year-to-date basis through the first three quarters there being that dividend achiever within international equity markets. That Invesco International Dividend Achievers Fund down there at a negative return of negative 25.64%, showing some pretty substantial dispersion between those areas and actually notching the highest continued dispersion that we've seen, taking that through trading yesterday. Continue to have momentum be the top performing area within that breakdown with a slightly better return over the past couple weeks here. So looking at a current year-to-date return for that momentum representative, ticker PIZ, of 10.63% through trading yesterday. And dividend achiever still being the lowest, but done a little bit better. So a negative return of negative 22.53%, bringing us to a dispersion of over 33% on the year between those two factors, which again is the highest that we've seen throughout the history of the test that we had there, going back certainly to 2009. And then actually, if you take it all the way back to 2006, still the highest dispersion that we've seen for the international factor perspective. So to take a little bit of a deeper dive into that, I mean, that conversation within the high dispersion leading to outperformance from momentum is a conversation that we've continued to harp on over the past few weeks here. And there's a few other ways that we can take a look at trying to identify areas of dispersion, areas of outperformance, or underperformance. And so if we take a look at another quilt, moving over to a quilt of the breakdown between the broad international representatives, looking at EFA, the iShares EFA ETF there for developed markets, EEM, the iShares Emerging Markets Fund for emerging markets, and then ticker ACWX, that broad MSCI XUS ETF there. Looking at a performance comparison on using the quilt tool that we have on the platform, brings us to EEM, unsurprisingly, being the top performing area that we've seen among these three at a year-to-date return of 2.36% through trading on Tuesday. EFA, the developed markets representative, is the worst performing area that we've seen between these three at a return of negative 6.65% there, bringing us to that dispersion of just over 9% on the year. So that dispersion is certainly higher than we've seen over the past couple years, but not the highest that we've seen, taking it all the way back there to 2005, with some areas looking specifically at 2015 to 2017, showing pretty high dispersion there, above 10% in each of those years. And then in years like 2013, 23% dispersion that we saw between EFA at the top performing area in that time versus the emerging markets representative EEM.
Yeah, Ian, and going back over time, especially over the last 15 years, a lot of advisors really put a lot of emphasis on EFA as their primary holding within the international space. But as we can see here, EM, or just broad emerging markets, has actually quadrupled the return over EFA. Actually, if you're planning on just holding a passive benchmark over time and you don't necessarily want to own just emerging markets, holding that global XUS balanced ACWX strategy has definitely returned much better than just holding something simple like EFA.
Yeah, absolutely, Darren. I mean, in looking at some other kind of applications to take this a little bit step further, Charlie, one thing that we were discussing was, okay, well, we have the broad representation here. We see EM continue to outperform on a year-to-date basis, really throughout most of this global equity rally that we've had since the COVID-induced low there in March. But taking a step further to look at some international region perspective, looking at a few different regions, specifically Asia, ex-Japan, Eurozone, Africa, and then Latin America, we can see a furthering of this conversation, that the dispersion we've seen this year, looking at through trading yesterday with the Asia representative being that top performing area at a little bit over 9% return on the year, and Latin America being the worst performing at over 33% loss on the year, bringing us in that dispersion of just over 43%, is among the highest readings we've seen on the regional perspective, and significantly higher than looking at those broad representatives there. The only year that we've seen in this test that's shown higher dispersion was back in 2009, where we saw a dispersion of 65% in what was certainly a volatile year there for international equities. But here we can continue to see that emerging markets breakdown that we saw that's continued to outperform has really been led in large part by some of these individual countries within the Asia region, looking specifically at areas like China and Taiwan that have continued to outperform over the past several weeks here. In other areas such as the more developed market focused areas in the Eurozone, and then certainly those areas within Latin America that have been hit pretty hard with the coronavirus there, that have continued to outperform at least through the first 3 quarters of the year here, Charlie.
Yeah, and piggybacking off that earlier point on the dispersion, a lot of people tend to look at international markets and they just think one blanket emerging market or East, like we had just shown. This definitely does help us dig down a little bit further and really look at those regions which operate very much so independent than everything else. In Asia, for instance, we've seen them continually be one of the top regions over the last 15 years. They're that nice bright yellow box, either in the first or second position the majority of years. And this dispersion is really one of the things that we look for when we're building portfolios and we're looking to create new strategies, because the wider dispersion that we're seeing and the more ability to get granular really does help us to produce returns that are going to be different than just owning a passive benchmark. And one of the top ways that we do that is through actually looking at individual countries. And so if you take this a step further and you start looking at individual countries, we actually looked at 33 individual country indexes that represent the majority of the globe, emerging and developed markets, and really dug in and continued to look at that dispersion. And what we've seen this year is that we've seen a 50% dispersion between the top country and the bottom country. And really, this 50% is pretty average. So going back the last 5 years, we've seen on average a 51% dispersion. This is actually real great, because what this means is that there are some countries that are just really knocking that cover off the ball, while other ones are really being those laggards and dragging that overall market down the steps. Tracking out a lot of names and then really over allocating to those top names, not only do we get a tailwind, but we're able to cut some of that extra cargo and really speed up the portfolio over time.
Yeah, absolutely there, Charlie. And another way that we can come in and take a look at some of the individual country representatives that we have on the system from a technical perspective is through a page that we have on the system called the Asset Class Group Scores page. And when coming in and looking at that particular ranking, there's a variety of view filters that you can use to sort the groups that you see on the page. And what those groups are, simply, we have 135 different investable areas of the market. And that's meant to represent everything from your individual domestic equity sector, size and styles, fixed income classifications, as well as non-U.S. specific regions and countries. And so you can sort that group or sort that page by non-U.S., hit that set view button, and then it'll only bring up those groups that are specifically pertaining to those international areas, with a few benchmarks thrown in there, such as the S&P 500 and all equity funds representatives. And so these groups are essentially going to be taking all the ETFs and mutual funds that we designate in a particular area, such as China, and averaging their fund scores together, fund scores from 0 to 6, to give us an average score for the group as a whole. So China, as an example, we have 83 different funds that we look at within the China equity space. And averaging each of those funds together gives us an average score for China of 4.41. This is the third highest group that we see on this particular page, and the highest individual country that we see ranked on this non-US ranking. In one way that we can take a look at some of the dispersion changes from a score perspective is to actually take a look at how these scores have changed on a graph. You can click off each of these areas and bring up a graph representation of how they've changed over time. And in looking at those over the past couple of years, we definitely see some areas move into favor in the international equities perspective, areas moving out of favor over the past couple of years. But largely it tended to kind of follow similar movements. International equities begin to decline. Most of the group scores within internationals begin to decline as well. The case is a little bit different since we come off the bottom there in March. In looking at areas that held up significantly better, looking at Super Pacific that didn't drop nearly as low as many of the other international equities, dropping to a score low there of about, is still maintaining above a score of average score of 2.0, whereas most other international regions fell significantly lower, with Latin America getting all the way down to 0.49 average score and continue to remain in low territory. Those areas that really held up better in that decline have been the areas that have improved more as well, or shown more strength recently, with creating more dispersion from a score perspective among these broad region representatives that we have on that group scores page. So in addition to the different performance breakdowns that we have, this technical score that we have here incorporates a variety of different factors. It goes into the fund score of each fund. That all goes into the group scores there that we see on the page. So definitely interesting to see that we see that kind of dispersion conversation continued with the areas of Super Pacific scoring very well at a recent score posting through Tuesday at 3.97, and areas like Latin America still remaining out of favor. So Charlie, if we continue to see this dispersion, I mean, the conversation looking just at the performance side of things too, carried over some of the other rankings that we have across the system, looking here at the asset class group scores as well as some others.
Yeah, that's exactly right, Ian. And as you know, one important point I think that often gets skipped is that these are all very technically driven scores that are really taking the emotion out. So when you look back at the post-recovery period, there's probably not a lot of people that would have said that Super Pacific would have been one of the areas that you really wanted to overweight going forward. But by really taking out that emotion out and really just looking at that raw data, looking at those momentum scores, if you were able to definitely capitalize on something that not a lot of people would have necessarily seen coming. Now, Ian, there is one more view that we look at, and that's using our matrix. So we actually go through and we look at all of those individual countries on a matrix standpoint. And what are some of the points that we're really seeing this year? Which countries are at the top of our ranks, and really which ones are leading the charge?
Yeah. So like you said, one of the other views that we have in addition to this is the matrix perspective. And what we've done recently is taken essentially the Nasdaq, individual Nasdaq country indices, 43 of those individual country representatives, and thrown those into a matrix to see, okay, which areas are strongest from a relative strength perspective, which are those areas that you want to maintain exposure to or look towards if you're looking to add international exposure, and where are those areas to avoid, right? And so the application of that is looking to really the top quartile of that matrix, so the top 11-ish names, are going to be those areas that we would have buy ratings on. Those areas that if you're looking for add international exposure, these are the more favorable areas. This is where you want to be. And in looking at those 11 names, I mean, as we've touched on, as we've seen in the performance breakdowns, as we've seen in rankings like this here, the emerging markets, specifically the Pacific area, has been really the name of the game, or at least most conversations have been centered around within international equities since that market bottom there in March. But in looking at those 11 names at the top of our international index matrix, we only see 2 emerging markets representatives there. And those 2 are coming from China and Taiwan. Taiwan currently ranking 2nd and China ranking 5th. But out of the other members of that top quartile that we see, those other 9, all developed market representatives, and mostly coming from the Nordic area, actually, with 5 of those representatives there. Denmark being the top ranked area, individual country in that matrix, and also seeing the Netherlands, Sweden, Finland, and Switzerland all showing pretty high position as well. So that's kind of taken it a step further to identify those areas that have led to have seen continued dispersion that we've seen led to increased performance from some of these individual countries. They might be a little bit different from just taking it at the broad developed versus emerging benchmark representation.
Yeah, and that's really building on all of that. This is really the process that we're thinking about when we're building either new models or new strategies. And something like ISV, which is a product that we do with First Trust, we take those countries and regions and we apply our relative strength methodology to them to really look at the underlying holdings without any emotion and overweight areas of strength and underweight areas of weakness. We also do something similar in BWCR and AAGR. Really, the common theme is taking emotion off the table, finding strength across the globe, and really over allocating to it, while at the same time really removing exposure to areas of the market that would be subtracted from the portfolio.
Yeah, absolutely, Charlie. And that's something we've seen across the board on the equity space really through this rally, right? I mean, as we touched on last week and we can continue to see today, I mean, momentum has been really that kind of bellwether leading us out of this market bottom, and seeing that displayed across momentum representation on the domestic equity side, as well as momentum representation, trying to capture this dispersion on the international side. This just speaks to that kind of continued strength as we look towards the end of 2020 here.
Yeah, that's exactly right. And I think looking into the U.S. elections, looking into continued developments with coronavirus, it's going to be ever more important to not only pay attention to portfolios, but really find ways to add an edge to your portfolio without all of the extra emotion that's involved with making forecasts.
Wonderful. Well, and so for those areas that we touched on there, some of those individual country representations that are going to be those higher relative strength areas. For those of you that are subscribers to our platform, we will be coming out with a piece actually later today in the daily equity report. So be sure to keep an eye out for that for the International Equity Spotlight. For those of you that are not subscribers, if you'd like to reach out and get a free trial of the subscription there, just go to www.dorseyright.com/trial, and we'll be sure to be able to get you signed up for a free trial there. If you have any questions on anything that we've covered here today, feel free to reach out to us at 804-320-8511, or shoot us an email there at dwa@dorseyright.com. So with that, Charlie, I think we touched on most of what we were looking to cover here today. So thank you very much for joining us here. And to all of you listeners, thank you very much for tuning in, and we'll see you next week.